Thank you, Danny. So as Danny said, today is officially my very last day in the Centre for Risk Studies, which I think means that I can get away with saying anything. But I'm not so this is it's kind of timed this way because I leave for Australia in 2 days' time. It also means that all my suits and clothes are all packed, hence why I'm in the last of my wardrobe. But it's a good opportunity to showcase and present some of the research that I've been doing with the rest of the FinCat team and other colleagues in the Centre for Risk Studies over the last couple of years. The title of my talk is Exploring Tail Risk in Financial Catastrophe, and I'm going to give an overview of the methods that we use, and then look at some of the historical scenarios that we've looked at to try and position these scenarios in that historical catalogue. So that's involved a lot of work going back through history, looking at different indicators and indexes over time and building that database up, and then also looking at developing different indicators for trying to understand and assess economic and financial catastrophes. So as Danny has said already, my presentation is going to be on the historical catalogue, and then we have 4 presenters each talking about these 4 scenarios. The first one is a global property crash and involves a sudden collapse in property prices in the inflated property markets around the world, and we've gone through an analysis to look at which property markets around the world are most inflated, and then did a cascade from that down different tiers of the global economy. In the next scenario, the Eurozone meltdown, we look at a cascade sovereign default scenario starting in Italy and then spreading across the Eurozone. In the high inflation world, we look at a spiral situation of energy and food prices getting out of control and increasing prices across the globe. We developed this scenario, by the way, much in advance of the recent deflationary world that we live in today. So this is, I guess, the opposite side of that stress test scenario. Then finally we have the dollar deposed scenario. So looking at what happens in a reserve currency shift, moving away from the US and to a place, in this example, to somewhere like China. This is the process that we follow across all of our scenarios. So they're all consistent in the way that we approach and the method that we use. Firstly, we look at the context. We build a justification, and we usually look at a 1% likelihood of event occurring. Then we establish the timeline and the footprint for that scenario occurring, and that can range from anywhere from less than a quarter to multiple years, depending on how we think that scenario might play out, and across different geographies of the world, as you can see in that map. We then build a narrative around that. That narrative is for communication purposes, but it also allows us to sense check and make sure that the scenarios are plausible. We then go through a loss assessment exercise based on that narrative. So we look at what different economic factors are most important for taking this scenario through to this stress testing in the macroeconomic modelling, which is the next step, where we apply these shocks in a macroeconomic model. And you heard about the Oxford Economics model earlier today, and we find that has been hugely beneficial in making sure that our scenarios are coherent across the entire globe and paint a good picture of what we think will happen under these scenarios. And then finally, the outputs of the Oxford Economics model go into a portfolio assessment. So one of the outputs of Oxford Economics is things like equity prices, interest rates, long-term, short-term interest rates, credit ratings, a range of different indicators on property indexes, things like that. And they go into our property investment portfolio model, and we have 4 standard portfolios that we look at applying these shocks across to see how those different portfolios perform under those different scenarios. So this is, of course, the Oxford Economics underlying trajectory for global GDP. Of course, there's countless number of other variables that underlie this model. So this is just kind of like the headline GDP figure that comes through here. But we know that throughout history, that road has been very turbulent and rocky, and we've just highlighted some of these here. On the y-axis here, this is a log scale, so you can see the impact of some of these different crises over time, and I'll be going through it in a little bit more detail on building up a more coherent record of these financial catastrophes. So you can see here, some of them have lasted for quite some time, and some of them have had very dramatic drops from peak to trough. A more recent example of a financial shock and contagion is the recent share market collapse in China, where we saw a peak to trough collapse of 27%. Now, much to our surprise, at the time before this occurred, and Andrew indicated to this in his presentation, that a lot of our colleagues and people that we work with didn't believe that a contagion like this could occur, but this is strong evidence that when, particularly now in a globalized world where we're much more connected through trade and our financial markets are much more connected, that when you get a shock in one part of the world, this quickly spreads to other parts of the globe. And we can see here 11%, 10%, 6%, 4%, 5% right across the world. Another recent crisis is the GFC, the Great Financial Crisis. And here what we've done is we've modelled what would have happened, the counterfactual, if this crisis didn't occur. So this is the red line that goes up here. And this is what actually did occur down here. And then we can look at what the loss applicable to the globe by the area under this curve here. So we call this the GDP at risk, and I'll explain a bit more about that later, but that allows us to then compare different catastrophes, financial catastrophes, but also other types of catastrophes like pandemics, wars, or anything using this metric. So looking at the burden of financial crises, we know that the Great Financial Crisis, using this estimate, cost the global economy around $20 trillion in 2010 dollars. And it is the most recent and most severe economic crisis for some time. The other most severe one was the Wall Street crash, which is again later on in my presentation. We know that these crises occur periodically. They have different causes, different triggers, and different severities associated with them. And I think Andrew mentioned as well that on average these occur around every 8 years. And using, if we go back throughout history and look at all these financial crises and add up what these losses may have been and then average that across all of those years, we estimate that the financial burden of these financial crises is about $500 billion to the globe on average every year. And that represents about a percentage point of global economic output. So that means that our growth, without financial crisis, could be around 4% a year rather than 3% a year on average. Financial crises are the single biggest, greatest economic risk to society, as you can see on this bar chart here. So given that this series of talks is about tail risks, I thought that I'd just put a slide in there to talk about tail risks and how the existing, how academics think about, how the financial markets think about tail risk. And I think the classic definition of a tail risk is you build a distribution of quarterly returns here as an example, and then you look at the tail of this, and this looks at the volatility over a short period of time, and the tail risk here is what your bar, so your probability of getting this level up. So you've got a 5% chance of getting a 2% loss in quarterly returns here. So this is the classical definition. It's very short term, it's high volatility, and it's a historical perspective, so it's looking short term. But I think what the financial markets are missing is this more long-term perspective. So it's looking more at this tail risk here, which is taking the trajectory out and comparing it with the counterfactual, and this under here is loss in output. And so that's what we're trying to do here with catastrophics and a measure like GDP at risk. Because what you can do is you can then, if you can model this, you can model different trajectories out here. Obviously, the further down you go, the lower the probability will be of that scenario occurring. But then you can build up a distribution, and then you can get a GDP at risk that's a probabilistic measure of how much a particular scenario will likely impact. And I think that this long-term or future forward-looking tail risk is, I think, where we need to start focusing a lot more research and attention. So building on this idea further, this is our indicator of GDP at risk. So this is the expected crisis, this is the area under the curve, and that there is a measure of our GDP at risk over the 5-year period. Because GDP changes and grows, we tend to also report not just the absolute GDP figure, but we also report the percentage GDP lost, which is essentially the area of this curve under here divided by the full area under here. And that allows us to compare throughout time as well, because it's just a percentage loss in GDP. And we found this useful for the Cities at Risk project because different cities have got different GDP, so you might get a large city that has a large GDP output having a large economic loss, but when you look at the percentage loss of that GDP, it's actually quite small compared to another emerging market where you might get a small total absolute value of GDP loss, but the percentage is a lot bigger.
Sorry, 22 questions. So, any earlier on you said financial crises are the responsible for the most dangerous events. Is it in this measure?
Using GDP risk, that's right. Yeah. This is how we, this is a common standard theme that we use in the central risk studies for comparing everything. Yeah. So now I'm going to go on to the learning from history part of my talk, and we believe that this is a key part to understanding the future. However, as rightly pointed out by other speakers and people throughout, many times throughout the conferences that we've held, you can't just rely on history. You need to do, because the structure of the economy changes all the time, you need to also build bottom-up models to try and understand this risk. So just relying on history isn't the be-all and end-all, but it does provide some data points for you to then build your stress tests around and then look at how, in the present world, these risks might play out. So it allows us to look at what happened in these financial crises, what drove them, what were the guiding economic characteristics and indicators at that time, what would happen if these crises would happen today. So we know that technologies have changed. We've had different revolutions. We have the industrial revolutions. Now we're going through a knowledge or an information revolution. This is obviously having important impacts on the economy, and we need to start considering these into our models for understanding what the impacts of a catastrophe might be in these new environments. And then finally, what we've done is we've looked throughout history and then looked at what the 12 most significant financial crises throughout history might be, and with our colleagues from the Centre for Financial History, in particular Dr. Duncan Needham, has written a 4 to 6 page summary on each of these crises. So we've got a good qualitative overview of and quantitative as well data on what has happened in each of these different scenarios and how they've played out. So looking at the environment that these scenarios occurred in, what was going on at the time, what were the important indicators to describe these events. So these are the 12 scenarios, ranging right back to 1720. I won't go through them all, but you can see here that we've identified the most important ones, including the most recent 2008 global financial crisis. In order to get a better idea of what has occurred over this period, we've constructed an extensive database of leading economic and financial indicators. So here's a quick snapshot of some of the indicators that we've developed in our database here. So obviously GDP is an important one, inflation rates, unemployment, government debt, household consumption levels, balance of payments, money supply, equity index, population levels, oil price. All of these things come together to create an economic environment. So they're all important in this analysis. And these are some of the databases or areas that we've extracted this information and put it together into a coherent framework to start looking at how these indicators work together. But there is a lot of problems with this data. It's sparse, the resolution is different, so sometimes you have monthly data, sometimes quarterly, sometimes annual. The further back you go, the less consistent it is. It's unconnected, so a big part of what I've done is try to connect these different time series together using different share price. For example, for the equity index construction that I looked at, you're going from maybe back in time, you're looking at just railway, the railway sector as a share price, but then further in time, you're adding more and more of these stock indices to this index to get a better picture. So obviously, the more recent data is more accurate, and the further back you go, the less accurate that data is. So as an example of an output of this data, this is US and UK equity indexes applied from 1800s to present day. And these vertical bars just indicate periods where you have some stress in the system. I guess one of the things that's obvious is that you kind of get a higher repetition of crises over this period moving forward. But then interestingly, if you look at the correlation between these two indexes, here you see the UK index moving very rapidly up and then crashing. Hasn't had much impact on the US. Again, here the US goes down rapidly, has a little effect here. Volatility here, we have massive decline here in the US, not so much in the UK. But then as we move up here, we can see a much better correlation more recently done. I think this is a strong indicator showing that the global financial network and our systems are much more integrated. So a shock occurring in one part of the world is having an impact elsewhere in the world as well. Crises can also be categorized in different ways. And so here, this is building on work from Reinhardt and Rogoff, where they identified different crises, so currency crisis, inflation crisis, asset bubble, sovereign crisis, and banking crisis. And looking at throughout this historical catalogue, we define a crisis, currency crisis as a 15% devaluation of the currency, 20% increase in prices, an asset bubble is a 25% drop in returns, a sovereign crisis is a failure to make payment on a loan, and a banking crisis is a significant failure, a failure of a significant bank. And we can see that crises have occurred, if you look at the number of crises that have occurred across all of these different types of crises, asset bubble being an important one, banking crisis, obviously, sovereign crisis, currency crisis, and and they happen at different rates compared to when you compare the United States and the United Kingdom. We can then look at what the impact on GDP was for all of these crises as well. The most important being the Wall Street crash here, over 20% decline in the States. Latin American crisis, a 5% decline in the United Kingdom. Another metric that we developed is this concept of peak to parity. So looking at the same equity index, we've looked at when these crises have occurred, the peak, and then looked at the trough, and then how long it takes to get back to where it would have been if when that crisis first occurred of that equity index. So then you can paint a picture, and you can look at the length of time that it's taken to reach back to its pre-crisis output level. And the most striking thing here is that some of these crises, the time it takes to get back to this peak to parity level is actually quite a long time. So here we see the Great Depression takes 25 years to get back to where it was before the crisis occurred. And we're just coming out of we're just reaching parity now with the Great Financial Crisis. It's taken 6 years to reach the pre-crisis equity levels. Again, we know that these crises, when they occur at the same time. So across the column headings here, we have the same different crises: so asset bubble, sovereign crisis, currency crisis, banking crisis, and the different types of crises that we've looked at. And you can see here that multiple crises can occur at the same time. So again, I guess amplifying the role of contagion across the economy and having an impact across multiple different factors, for example, currency or government debt or equity markets. So building on all of this historical data, we've developed this taxonomy of financial crisis, which we believe attempts to cover all of the different types of financial crises. So moving here from the top right, we have inflation, cost push, inflation, demand pull, and of course deflation. We have banking crisis. This can occur from a systemic failure, a bank run, or a credit crunch, all very familiar over the last decade or so. Asset bubble shock, so stock market crash, commodity price bubble, property price bubble, and then illegal activity, probably not talked about that often, but can also cause a lot of damage to the financial sector: fraud, financial irregularity, debt. This can be sovereign debt or private debt. We have currency crisis, so what happens during a reserve currency shift, and that is one of the scenarios that we model here today, or the currency shock. And then more recently, I think these are becoming more important, are these complex or technological type crises. So we have a flash crash, black box type trading, complex derivatives, and cyber crashes. There was a question earlier, I think by Richard, who asked the question, what is the chance of a $1 trillion event occurring in the next 3 years? Was that the question? So this doesn't answer directly that question, but it does go some way. So what I've done here is I've looked at the peak to trough declines over the last 200 years and plotted them on a histogram here, and then using a normal distribution. We know that the crises don't take a normal distribution, but that's the standard in the financial markets, particularly when you're estimating something like VAR. And so what this says is that we have a 1% probability in any year that we're going to have a 35% shock on US equities. And then if there's a 5% chance in any year that we're going to have a 23.6% shock. And the mean is a 5.7% growth rate. And again, we can do this for GDP and look at what the annual percentage, so the 1% or the tail event, what would be the GDP at risk here? That would be 13% and 5.1% for GDP. Andrew showed this slide, so I'm not going to go into too much detail on it, just to show that you can then compare and rank the different crises that have occurred over time. You can look at how many crises have caused a crash greater than 50% loss in the equity markets, and the average years between these types of crises. I spoke earlier about the idea of what would happen if these crises occurred today, and this is an attempt using the Oxford Economics model to put in the parameters that we've taken from this historical data set, looking at how big these shocks have been, and then put them into the model for 2015, and then let the Oxford Economics solve that for those parameters. So in the model goes things like unemployment rates, equity index shocks, a number of other things, inflation, and then we look at how this plays out. And you can see here that all of these crises have different rebound and different effects on the global economy, but typically you are getting this reversion back to the pre-baseline condition. This great financial crisis line here, because we have data on that, I've used actual data to show what that would look like compared to the trajectory of it not occurring. So with all this information, it goes into scenario stress tests, where we pose these what-if questions. They help us deal with complexity and uncertainty. It's important to note that these are not predictions or forecasts, so keep in mind for the other presentations that are coming after mine, but they are a coherent set of plausible expectations about the future, and we hope that these scenarios can be used to improve business resilience to the types of shocks that we're looking at. Here's what I've tried to categorize as the 7 critical characteristics of stress tests. Improbable, so they need to be unlikely events, they need to be coherent, they need to be quantifiable, so putting metrics on them so you can actually use them and compare them with each other. They need to be relevant to industry professionals, they need to be plausible, pass the C-level test, so you're talking about it with someone and they don't just fob you off as being ridiculous. They need to be challenging enough to change the status quo, to implement new business models or implement new resilience procedures, and they ideally will include variation. So that's, in our scenarios, we include S1, S2, and X1 to show what the range of estimates might be. So now comparing this with what we have done, so the top 5 are the estimates from the simulated impacts of the historical financial crisis if they played out today. This is what the GDP at risk of these crises would be, and this is compared to our Cambridge Risk Centre crises. So here we see the dollar deposed 2 to 3 trillion, similar in range to the Bering banking crisis, all the way down to our global property crash, which is our largest scenario, in a similar range to the Wall Street crash. And for those who are familiar with the work of the Risk Centre, this slide shows how the different GDP at risk compare across the different scenarios that we've completed already. And you can see here that the global property crash is our second largest scenario stress test behind the China-Japan conflict. So in summary, we believe that the financial catastrophes didn't occur, the world would grow about 1/3 faster than it does today. We say that the financial catastrophes are the single greatest risk to economic output in our threat universe, so there's a real imperative to try and understand and minimize and mitigate these risks. The tools that people are using, and I've shown some examples, we think are presently inadequate, and a lot more research needs to be done to try and improve the tools that are using to try and understand these risks, particularly these forward-looking and long-tail risks. And contagion is an important part of that, and we've already heard today that contagion is inherently difficult to measure and understand accurately.